Hi, thanks so much for joining in. You're watching NDTV Profit. My name is Alex Matthew, and this is the coverage of the RBI monetary policy. Now, we've seen all of the key highlights over the course of the last couple of hours. In fact, just a short while back, you had the culmination of the press conference that was hosted by the Reserve Bank of India to talk about the decision that was made. And in case you missed it, that decision was a 5:1 vote by the Monetary Policy Committee to hold the rates unchanged, and perhaps more importantly, from the perspective of future course of monetary policy, a unanimous vote by the 6 members of the Monetary Policy Committee to change the stance to neutral from withdrawal of accommodation. Just a short while back, you had the Reserve Bank of India governor say that everything that was meant to be achieved in the withdrawal of accommodation has been achieved, and that is why the stance was changed to neutral. Now, there's more to talk about, including the projection on growth as well as the projection on inflation, which has remained unchanged for the full financial year. But to talk about the key highlights and the key takeaways from the rate decision, from the monetary policy decision of the committee, I'm joined by my colleague Pallavi Nahata. Pallavi, what stood out to you?
Hi, Alex. So, like you've mentioned, of course, while the benchmark lending rate was retained at 6.5%, we did see a change in stance to neutral. And what stood out, in fact, in the recently concluded presser was the RBI governor and deputy governors emphasizing that the change in stance needs to be looked at independently. And what that possibly meant was, given the entire, given that the governor did continue to emphasize that they're continuing to very closely monitor inflation, it continues to remain a data-dependent approach that the RBI continues to take. We're going to be watching out for a whole host of factors, how they evolve, especially the upside risks to inflation that the governor highlighted multiple times during his speech earlier and during the course of the press conference as well. But of course, apart from what was said about the change in stance, the rationale behind it, and how it needs to be viewed independently, what also stood out, like you mentioned, was the fact that CPI inflation forecast for the full year was retained, and as was the GDP growth forecast. That was something that definitely stood out, because a lot of us had been expecting possibly a small cut in the GDP growth forecast, given where we've seen Q1 numbers come at, given we have seen some easing in high-frequency data post that as well. But in fact, in response to a question by NDTV Profit, the governor actually did say that economic activity continues to remain resilient. They do not think that the current lending rate is actually impinging on growth or is likely to do so going forward. That was also one of the key takeaways from the presser. So let's have a quick look at what the forecasts were. For CPI, we continue to look at, Q2 at 4.1%, Q3 at 4.8%, and Q4 at 4.2%, with risks evenly balanced. I think one of the last key takeaways was, of course, the message that the governor sent out to NBFCs.
Right.
And during the course of the presser as well, they did say that while it was not directed specifically, broadly at an industry level, while there is no reason for concern, that is something they want, players in the industry to sort of course correct on by themselves going forward.
Absolutely.
Just the pace of growth and what's sustainable.
Yeah, absolutely. In fact, we're going to talk about that with our guest today as well. Pallavi, we're joined by Abheek Barua, who is a chief economist and executive vice president at HDFC Bank, as well as Anubhuti Sahay, who is the head South Asia Economics Research at Standard Chartered Bank. Thank you so much to the both of you for taking the time this afternoon. I'm curious about what you have to say about the change in stance, because as I saw the expectations today, 10 out of 13 economists that have been polled had expected the rates to remain unchanged. Were you anticipating a change in the stance, and what did you make of the comments that were made by the central bank governor as well as his...
Sorry.
Please go ahead.
I certainly was anticipating a change in stance. and I wouldn't necessarily see it as independent of future rate action. I think what the change in stance does is kind of build the base for a possible rate cut going forward. If you still had withdrawal of accommodation, it would be a little more difficult to actually cut rates. So maybe they are building towards it. Pallavi gave a very succinct summary of what the message was, and indeed there are a number of risks on the horizon, particularly coming from things like fuel prices, metal prices, because we still don't know how the Middle East and even China will play out. Because there was temporary euphoria about China, which sort of pushed up metal prices a little. Oil, we know, is very, very uncertain. There is a little bit of a question mark on food. That said, if things do remain kind of well behaved, and I think this opens up the room for a rate cut going forward. I wouldn't I stick my neck out and say that if things actually behave well, then December might be the first time they cut rates, but I wouldn't really bet on it. But one thing I just wanted to point out, if you allow me, is that I mean there was a lot of discussion around the fact that the Fed has cut rates and the RBI will follow, and there is a sort of synchronization across central banks, etc. I think the RBI's line has been that the domestic conditions are central to decision making, and external factors have a limited impact. They do, I'm sure,
Right.
play some kind of a role. But I think we emphasize the centrality of domestic conditions in a rate and monetary policy decisions on the whole.
Yeah, it's an important point that you make. Anubhuti, I'm curious what you make of what was just said by Abheek, and also the point that was made at the end of the press conference, if you heard it. Pallavi herself asked that question. The fact that there is a mixed bag in terms of high frequency indicators, the stance is neutral. There are concerns that some people have raised that economic growth is not as robust as some might think. But the RBI governor seemed quite sanguine about that. Are you?
Well, our growth projection is at 6.9%. This is only slightly different, a little lower than where RBI is projecting it, which is at 7.2%. And I think we agree with the broader narrative that we can see a much better growth environment getting into the second half. Primarily driven by a revival in rural demand, plus government capex picking up, etc. But in terms of GDP projections itself, I think if there might be some disappointment at the market level, because markets have got used to growth numbers in the 7 to 8% kind of a range over in FY24 in specific. But in the next 3 to 4 quarters, we'll clearly see a downtick moving the growth projections or growth numbers printing in the range of 6.5 to 7%. To that extent, it can be disappointing, can increase voices around rate cuts, but it will be a far more inclusive growth. And probably we, as economists, we always prefer GVA. And in terms of GVA, our sense is the numbers won't be very different from where we were last year. Now, coming to this policy in specific, I would say that the policy clearly had dovish undertones. I think the change in stance is just one small part of it. But if you look at the way the description around inflation has evolved over the past few quarters, from saying Arjuna's eye to talking about elephant is still needs to reach the forest, to talking about horse and stable. And even if you read the statement, there is a very specific phrase where he says that inflation is now closer to the target. So I think it's a big shift which we have seen over the last couple of meetings and what we heard today. Of course, he has to caveat it. The governor has to caveat it. The MPC has to keep the optionality, whether it is about the global external risks or about India's own food inflation trajectory. But December looks a high probability meeting where we might see a rate cut happening unless something goes wrong externally, or if the deviation from the 5% inflation, both in September and October, is significantly on the higher side. Unless these two things play out, I think December rate cut looks now, pretty likely in our view.
Am I right in assuming both of you that, and both of you have talked about a December rate cut, but a small one, 25 basis points on the cards? I'm guessing that is the case. Now, I'm curious about what you think about the external factors, because the governor stressed about this several times over the course of the policy statement, as well as in the press conference where he spoke about energy prices globally. He's spoken about geopolitical risks as being a key factor to watch. According to you, is this the fly in the ointment that could change projections completely? Is this something that would change the narrative as well? Crude oil prices estimated at what, $80? Abheek, does that change dramatically if crude oil prices spike?
Absolutely. I don't think it changes the fundamental narrative that we've sort of got inflation more or less under control. But I mean, if these risks were to pan out, then there is a problem. And the immediacy of the urgency of rate cuts, given the scenario on growth that Anubhuti painted, that you might see some disappointments at both at the headline level and also at the more granular level. And I kind of agree with that, even with some sort of more informal data that we are picking up as a bank. Now, if you if things go completely haywire, particularly on the geopolitical side, and don't forget that U.S. elections are also around the corner. We really don't know how that will play out in terms of expectations. If there are high tariff expectations, for instance, then you are looking at a potentially inflationary scenario. So I think there are a lot of known unknowns, and if things go a little awry, December might not be the time to cut, and it's going to be very data dependent. It's going to be very event dependent. But I think the underlying sort of languaging and the description or narrative will be in place, and this will be seen as kind of temporary deviations. I don't see the narrative fundamentally changing. It'll sort of be a put on hold kind of approach that the RBI will have to use to accommodate or respond to domestic shocks or external shocks.
Okay. I'm curious about what Anubhuti has to say about what was discussed beyond the scope of just the RBI monetary policy, because there were statements that were made about regulation in the banking space, in the NBFC space, that potentially posing systemic risk. The RBI stopping short of making any declarations or changes in the regulations, but saying, be cautious. What did you make of that?
Sure. So I think here the messaging is very clear. In fact, we have been seeing a whole host of measures being rolled out by the RBI since late last year, and it's extremely important to keep a check on it. Even though unsecured loan growth has climbed down, it's still at it's still in double digits, and probably that is something which keeps RBI extremely vigilant. Imagine a scenario going forward, say next 6 months, not necessarily December itself. If interest rates in India, RBI, if RBI starts easing interest rates, this in turn can undo a lot of a decline in unsecured loans which has happened, and probably can fuel lending in areas which are not that comfortable for the regulators. So I think this also paves the way forward for easing the interest rates for the economy at large, but at the same time rolling out measures, macroprudential measures, to ensure that easy liquidity at easier price does not fuel some kind of vulnerability in the financial sector over a period of time. So I think it's a very good approach, and probably we are likely to see more of these going forward, especially when the easing cycle starts, and in case these areas of concern are not fully addressed by specific entities.
All right, Abheek, Right. Abhi, coming to you, I do want to ask you, while the broad consensus does appear to be that we could see a possible rate cut, presumably of about 25 basis points in December, is the rate cut cycle still expected to be a shallow one? And also, how much of an impact do you think that will help provide to growth impulses, given that we did see a little bit of easing there? Also, what's your projection on GDP growth forecast for this year?
We are a little more, so let me start with your last question. We are a little more conservative, I would say far more conservative on GDP growth. We have a number of 6.8%, which is not significantly different. But I think qualitatively, it sort of indicates that there are pockets of concern, which perhaps the RBI is not highlighting that much. I see private investments as a problem area because, and I'm glad you sort of cut across to the Hyundai IPO, because if you saw some of the numbers, one of the numbers at least, that the Axis Mutual Fund had released just a couple of months back, it showed that for the pipeline of IPOs that we'd seen over the last 14 months, only about 6% was for CapEx. Hyundai is one where clearly there is a lot of CapEx associated with it. But in terms of while there are intentions, financial closures have taken place, credit drawdown for investment purposes have been slow. And I mean, I think that there would be some consensus across banks on this phenomena. So there is, there are some concerns about growth. Yeah, I really don't know whether this will be a shallow rate. I would presume that this would be a shallow rate cut cycle because I think with the way the things are going in terms of the frequency of shocks and the extremely difficult external environment, I think we're moving to relatively higher inflation scenario on a long-term basis. So I think for central banks in general, rate cuts will have to be will be perhaps shallower, and I think the relationship between growth and the rate changes have kind of weakened a little. So you might just sort of get away with relatively good growth, low unemployment, and yet not have to cut much. So that's a sort of neutral rate argument, which is there for the US, which is there for the Indian economy and so forth, that the neutral rate is actually increased. So, that in a nutshell is my point. I think that the RBI, to cut a long story short, the RBI is not recognizing some of the risks. I think the private consumption number in the first quarter GDP was a huge overestimate, which none of the consumer companies would sort of agree with. And I think there is a problem, with private investments, except in a couple of sectors. Whether interest rates cuts will make a difference or not, whether these decisions are influenced by the cost of capital in India or emerging markets like India, is another
Right.
long story. But I mean, there is a problem. Let me say that I see it as a problem, which is partly reflected in my GDP projection.
Okay. Anubhuti, do you share some of those concerns, especially, for instance, the RBI is, for instance, banking on some sort of a recovery taking place in the rural sector. We're already, of course, seeing some signs of that, that along with the, excess rainfall that we've seen in the southwest monsoons, the expected outcome from agricultural sector, but also the fact that, a lot of sort of corporate earnings, for instance, do seem to belie the extent of the recovery we're talking about. Is that a concern you share, maybe, Anubhuti?
Yeah. Yeah, sure, Pallavi. So as before you joined, we did discuss this. So our growth projections are at 6.9%. And I think the narrative with which we agree what the governor highlighted is that we do see a revival in rural demand driven by a good monsoon, but it will take time to show up in the GDP numbers. Private investment will still take time to come back in a significant manner, especially in the current global environment where there are a lot of uncertainties around geopolitical tension, presidential election results in the US, and government capex will has started picking up, but of course there is a limit to which it can push growth higher. So to that extent, the GDP numbers to the market at large might disappoint. The market had got used to a GDP number in the range of 7 to 8%, very broadly put. We are over the next few quarters headed towards a GDP range of 6.5 to 7%. And that will come as a disappointment. Though, as economists, when we look at GVA, that disappointment will not be that strong. Of course, there are a few areas of concern, like private investment, etc., etc. Those concerns have been there for quite some time. But overall GDP, story in our view is likely to become far more inclusive, and I would say that I'll be far more happier with a 6.9% GDP growth number rather than an 8.2%, which was so non-inclusive.
Yeah, that's a very fair point and an interesting one that you make at the end of this conversation that we're having with you. Thank you so much to the both of you, Abheek as well as Anubhuti, for joining us this afternoon and giving us your perspective. Pallavi, insightful chat. I'm curious about what you have to say about the RBI governor and some of the analogies that he has used over the course of the last few monetary policies. I'm sure that our viewers have some recollection of some of this, where they've heard the RBI governor talk about the elephant that has been in the forest and that has refused to move away. And there he's talking about inflation. He's changed his analogy today to talk about horses. And somebody asked him on the press conference why he's using horses and elephants, and here's what he had to say.
It's not a shift. The reason for earlier I used elephant, this time I'm using horse. The reason is that it's a war against inflation. And in a war, elephants and horses are used historically. Arjuna will come when there is a requirement. Arjuna, with his Brahmastra or with Narayanastra or the various astras that Arjuna has, will come back if and when necessary.
All right, if and when necessary. And quite an interesting analogy that has been provided by the Reserve Bank of India, and that kind of helps you understand monetary policy in a better way as well. The RBI and the Monetary Policy Committee, of course, as you know, targets inflation. And so the analogy of Arjuna is quite appropriate here. Let's talk about the expectation of rate cuts going forward, because that really is what the street is focused on. The stance shift to neutral is something that was seen as positive by the street, and the equity markets are trading higher on account of that. But we asked a host of experts what they make of the policy decision and the timeline of future rate cuts. Here's what they said.
As far as stance is concerned, they have already started infusing liquidity, and with the surplus liquidity, they had to change the stance. In terms of rate cut, they would like to see the actual figures. So that's where, right now, because of the base effect, the projection of inflation has not been changed at all. Even the GDP growth projection has not been changed at all. So by December, I think both of that could be lower, and that's where we have the scope for change in rate. Because as of right now, though inflation is under control and real rates are higher, but GDP is not the GDP is not suffering, the growth is not suffering, and that's why you could keep higher real rates of 2%, but that has to change, and maybe hopefully they will do that in December.
All right, December is when we're expecting to see a rate cut. But that's all the time we have for you on this edition or this particular show, but there's lots lined up over the course of the day. Do stay tuned. This is NDTV Profit.